Welcome to the Pro Ticker Deep Dive.
It's great to be here.
Let's be honest with each other for a second. If you opened your portfolio this morning, it is Monday, February 9, 2026. You felt it, didn't you?
Oh, yeah. The shift.
It's more than a shift. It feels like a gear change. We spent so much of 2025 in this sort of defensive crouch. You know that feeling.
Absolutely. Just watching the Fed, watching every geopolitical headline, probably holding a little too much cash on the sidelines, just waiting.
Waiting for the other shoe to drop?
Yeah.
But today, it really feels like the starting gun just went off.
The psychological pivot is palpable. I mean, it's not just a feeling. We're seeing capital move from what you could call preservation mode right into deployment mode.
And it's not just retail traders, right? This isn't about people chasing memes in their pajamas.
No. This is institutional weight shifting. You can almost hear the heavy machinery starting to move in the background. It's a different sound.
That is exactly what we need to unpack. Because the headline number we're all looking at today isn't a stock price. It isn't an earnings beat. It's a capital projection. We're looking at data that suggests a triple-fold increase in capital raising this year.
The IPO market.
Exactly, the IPO market. We are talking about going from a sleepy and, let's be honest, a frankly boring $48 billion in 2025,
Which was anemic.
to a projected $160 billion in 2026.
Yeah.
That is a wall of money. That is a tsunami of paper hitting the market.
It is.
But here's my concern, and this is what I want us to really tear apart today. Is this a sign of a healthy, roaring economy? Or is this the blow-off top? Is this the party just getting started? Or is this the bartender shouting last call and everyone is scrambling to order one more round?
That is the trillion-dollar question, isn't it? Because when you look at the research stack we have in front of us today, from, Goldman Sachs' big macro thesis all the way down to the specific drama with SpaceX and AppLovin, you start to see a very specific picture forming. It's not just stocks going up, it's about which stocks are going up and, maybe more importantly, at what cost.
Right. And we have a massive slate. We're going to dissect this Goldman Sachs gold rush thesis to see if it actually holds water. We absolutely need to talk about SpaceX because there is a fascinating pivot happening there. It involves the moon, and I think it tells us more about the IPO market than any stock chart ever could.
Oh, it's a masterclass in narrative control. Absolutely.
And on top of that, we've also got AppLovin swinging 15% in a single day on legal drama. We have insiders selling at Boeing. That might not be what it seems on the surface. And some very, very strange signals coming out of the crypto market regarding Ethereum.
A death zone.
Which sounds absolutely terrifying, I'm not going to lie. But let's start at the top of the food chain, the macro view. Goldman Sachs came out this morning with a thesis that is essentially telling the market the window is open.
And not just open, but thrown wide. I mean, the projection of $160 billion in IPO volume for 2026 is aggressive. It's really aggressive. To put that $48 billion from 2025 in perspective, that was, as I said, anemia. That was bankers sitting on their hands, playing solitaire on their computers.
Okay, but why? Why was it so dead?
Yeah.
2025 wasn't a deep recession? Not exactly. So why was the IPO market a complete ghost town?
One word. Uncertainty. You have to understand, an IPO, an initial public offering, is fundamentally a liquidity event. It requires a stable backdrop to succeed.
And we didn't have that.
We had rate volatility, we had geopolitical noise. If you're a CFO and you can't predict what the cost of your capital will be in 6 months, you do not file that S-1 form with the SEC. You wait. You just don't launch a boat in the middle of a hurricane.
So what changed today? Why is the hurricane suddenly over? Goldman lists 3 main pillars for this new thesis. Let's try and stress test them. The first one is accommodative monetary policy.
Which is, just Wall Street speak for the Fed isn't fighting us anymore. They've put the weapons down.
Let's break that down, though. For the listener who hears the word accommodative and just thinks nice, what does that actually mean for the real gears of the economy?
It's all about liquidity. When policy is accommodative, liquidity is ample. It means the risk-free rate, that's what you get for just holding safe government bonds, is stable or even coming down.
So your safe money isn't making you as much.
Exactly. And that forces money out of safety and into risk assets, like new stocks from an IPO. It also means that borrowing costs for these companies are predictable, which is huge. If you are a growth company and you're burning cash to grow,
which most of them are.
Almost all of them are. Accommodative means you can fund your operations without giving away the whole company to a lender. It makes planning possible.
Okay, so the money is cheap, or at least the price tag isn't changing every single week. That makes sense. The second pillar they mention is higher executive confidence. This one always feels a bit squishy to me. How do they measure that? Is there a CEO mood ring I don't know about?
Huh, I wish. No, it's partly from survey data. They ask them directly. But it's mostly behavioral. You just have to look at the filing pipeline.
What do you mean?
CEOs are notoriously herd-like animals. No one wants to be the first person to jump into a freezing cold lake. But once a few big names go public and the stock pops on the first day,
Everyone else rushes in.
suddenly every CEO is on the phone with their banker saying, okay, the water is fine, let's go. What Goldman is seeing is that huge backlog of private companies. Companies that have been sitting on the sidelines for 2, maybe 3 years, they're all starting to prep their paperwork now.
So it's basically FOMO, fear of missing out, but for billionaires and venture capitalists.
Essentially, yes. And it's a competitive thing, too. If your biggest competitor goes public and raises $1 billion in fresh capital, you are suddenly at a massive strategic disadvantage if you stay private. You almost have to follow suit just to keep up.
Okay, and the third pillar is the simplest one. Just a strong economy.
The macro backdrop. Employment is holding up. Consumer spending is still there, even with some pressures. In this environment, you can sell a growth story. Investors are willing to believe in the promise of tomorrow because today looks pretty good.
But hold on a second. You mentioned stress testing this. Goldman isn't promising a rose garden here. They flagged a specific risk that really caught my eye, and I think this is where the devil is in the details. They called it the software problem.
This is the fly in the ointment. It's a big one.
And it's so counterintuitive. Usually software is the absolute darling of the IPO world. SaaS, software as a service, high margin, sticky, recurring revenue. Investors absolutely love it. It's the golden child.
Historically, yes. For the last decade, if you wanted a guaranteed pop on your IPO, you were a high-growth software company. But Goldman is pointing out what they call a recent route in the publicly traded software stocks. And this is critical because of how new IPOs are actually priced.
Explain that mechanism. Why does the stock price of, say, Salesforce or Adobe, why does that matter to a little startup that nobody's even heard of yet?
It's all about the comparables, or comps, as they're called on the street. If you are a private software company, let's call it Databrick X, and you want to go public, your investment bankers look at the existing public companies, the Salesforces, the Adobes, the Snowflakes of the world, to set your price.
They're looking for a benchmark.
A benchmark for the multiple, valuation multiple.
So if Salesforce is trading at, let's say, 8 times its annual revenue.
Exactly. Then you can't come out of the gate asking for 20 times revenue. It's just not going to fly. If the comps are trading down, if their valuation multiples have compressed from maybe 20x revenue a few years ago down to 8x revenue today, then you, the private company, have to take a haircut on your valuation. You just can't ask for 2021 prices in a 2026 market.
So what you're saying is even if the volume of IPOs goes way up, the valuations of these companies might be pretty disappointing for the founders and the early investors.
Precisely. And that creates a very real friction point. It becomes a question of ego. Will founders swallow their pride and list at a lower price because they need the cash to grow? Or will they keep waiting for the good old days of those crazy multiples to return?
And Goldman thinks.
Goldman thinks they'll list. They think the need for capital will win out. But that software route is a major headwind. It means the IPOs might happen, but they might not be these explosive day-one successes that we got so used to seeing.
Now, there's one more piece of the Goldman note that I found genuinely unsettling. I'm not sure what to make of it. They called it the Ben Snyder signal. For those who don't know, Ben Snyder is their chief U.S. equity strategist, and he highlighted a correlation in the data that feels like a trap.
It's the party paradox. That's what I call it.
The party paradox. Okay, walk us through this.
So Snyder's data shows that when IPO volume is high, like what we're projecting for 2026, the S&P 500 tends to perform very well during that same period.
Which makes intuitive sense, right? Optimism feeds optimism. If everyone is excited and buying newly listed stocks, they're probably feeling good and buying the old established stocks too.
Right. The animal spirits are running hot. It's a hot market. But, and here's the hammer drop, the historical data also shows that stock market returns subsequent to an IPO boom tend to be significantly below average.
Okay, translate that for the listener who is sitting there thinking about putting more money into their 401k right now.
It means we are likely eating our dessert first. An IPO boom, historically, signals that we are late in the economic cycle. It's a sign of peak optimism. Companies are rushing to go public because their owners and bankers think valuations are peaking. They want to sell their shares to you at the top.
That is incredibly cynical, but it's probably true. They aren't going public because they want to share the future wealth with you. They're going public because they want to cash out at the best possible price.
It's just capitalism. It's how the machine works. So Snyder is essentially putting out a warning. He's saying, enjoy the rally in 2026, but you need to understand that you are borrowing returns from 2027 and 2028.
Why? What's the mechanism there?
It's simple supply and demand. The supply of available shares is increasing dramatically. Every single one of these IPOs creates new stock that has to be bought and absorbed by the market, and eventually that new supply overwhelms the available demand and prices have to come down.
So the gold rush is real, but we might just be the ones buying the shovels at highly inflated prices right before the gold runs out.
That's a perfect way to put it. Caution is warranted.
Speaking of inflated prices, or at least astronomical ones, we absolutely have to talk about the elephant, or maybe the rocket, in the room. SpaceX.
The billion-dollar gorilla.
$800 billion, to be precise. That was the valuation that was pinned on them in a private transaction last month. That is bigger than Tesla was for a long time. It's bigger than almost every company in the S&P 500.
And they are still a private company. This is the white whale of the IPO market. If and when SpaceX files to go public, it will suck all the oxygen out of the entire room. Every fund manager on the planet will have to buy it.
But the big story today isn't just about that valuation. It's about the mission. For a decade, the entire SpaceX brand has been synonymous with one thing: Mars, colonization, being a multiplanetary species.
The red planet dream. It's the visionary hook that got everyone excited.
But today, we're getting news that the Mars landing timeline is being pushed back. And suddenly, all the focus is on something they're calling the 2027 moonshot.
This pivot is absolutely fascinating. And if you look at it purely through the lens of a potential IPO, it makes perfect calculated sense.
Walk me through that. Why does the moon play better on Wall Street than Mars? I mean, Mars is cooler. Mars is the future. It's the grand vision.
Mars is cool, but from a financial perspective, Mars is a capex sinkhole. It is a money pit. It requires hundreds of billions of dollars in R&D, new infrastructure, life support systems, with absolutely zero near-term return on investment. It's a vanity project, a very noble one, but it is a financial black hole.
And the moon?
The moon is a business model. The moon means NASA contracts. It means the Artemis program. It's building infrastructure that the U.S. government is actively paying for right now. It has a line item in the federal budget.
So by shifting the public narrative from Mars to a 2027 moonshot, what they're really doing is telling potential investors, look, we have guaranteed revenue streams.
Exactly. They're saying we have a deliverable schedule. We have government checks that are clearing every quarter.
Yeah.
It completely de-risks the investment for a big conservative institution.
So it's about the roadshow.
It's all about the roadshow. If you go to a room full of pension fund managers and you say, invest in us, we're going to Mars sometime in 2040, they'll walk out of the room. They can't put that in their financial models. But if you walk in and say, invest in us, we're landing on the moon next year as part of a multi-billion-dollar government contract, they will sign the check on the spot.
That is such a crucial insight. This isn't just an engineering delay. This is financial engineering. They're trying to build a case to justify that $800 billion price tag to the public markets.
It's cleaning up the story. It's a very clear signal that they're getting serious about a liquidity event. They are strategically moving their public narrative from sci-fi visionaries to reliable government contractor.
Which is, let's face it, a lot less sexy, but a whole lot more profitable.
Precisely.
Okay, so while SpaceX is busy polishing its reputation for Wall Street, another company has been fighting for its life, or at least it was until this morning. Let's talk about AppLovin, ticker symbol APPP.
This is the volatility story of the day, hands down.
We are looking at a 15% swing to the upside today. I think it was 14.78% at the time of recording. And this isn't because they released some killer new product or a great earnings report.
No, it's much simpler than that. It's because a black cloud that was hanging over the stock just evaporated.
So rewind for us. What was this black cloud?
A financial publisher had released a report with some very, very severe claims accusing AppLovin of money laundering.
Wow. Okay. For a publicly traded company, that is about as bad as it gets. Those two words, money laundering, are completely radioactive.
They're a death knell.
Can you explain what happens behind the scenes when a report like that drops? Because it's not just humans reading it and getting scared, is it? It's not just some guy in Connecticut reading the Wall Street Journal over his cereal.
Oh, absolutely not. The moment that headline hits the wire, algorithmic trading bots are scanning the text. Their programming identifies keywords. They see money laundering, illegal activity, SEC investigation, and they instantly execute sell orders. They are programmed to dump the stock before a human trader has even taken a sip of their coffee.
It's a programmed panic, a digital bank run.
That's a great way to put it. It creates a vacuum. All the buyers disappear. The stock craters because the market makers and liquidity providers pull their bids. The market, for a brief period, priced in a non-zero probability that Applevin was a criminal enterprise that was going to be shut down by the feds.
And today?
Today, the publisher withdrew the claims. They retracted the story.
Oops, are bad.
Essentially. And the rubber band that was stretched to its breaking point just snapped back. The 15% rally you're seeing today isn't the market saying the underlying business is suddenly better. It's the market simply removing that criminal activity discount that it had priced in.
It is terrifying how fragile value is in the public markets. You can lose billions in market cap on an allegation and then gain it all back on a one-sentence retraction. But for the listener, what is the actual lesson here? Do you try to be a hero and catch that falling knife when these reports come out?
It is incredibly dangerous. We call it headline risk, and it's a killer. If you bought Applevin yesterday, you look like an absolute genius today. But you have to remember, if that report had been substantiated, if the Department of Justice had announced a formal investigation this morning instead of a retraction, that stock would have gone to zero.
So it's completely binary outcome.
It's gambling, not investing. Unless you have some kind of inside knowledge of their accounting and compliance books, which you don't, you are just betting on a coin flip.
And as we all know, usually the house wins.
Usually.
Speaking of inside knowledge, let's pivot over to Boeing, ticker BA.
An American industrial icon that seems to be in the news for all the wrong reasons lately.
The stock itself is pretty quiet today, up just a fraction of a percent. But the SEC filings are active. We have confirmed insider selling. 2 senior executives, including the chief engineer, a guy named Howard E. McKenzie, sold over $3 million worth of stock on February 5th.
And whenever the words chief engineer and selling stock appear in the same sentence regarding Boeing, people understandably get very nervous. Their first thought is, what does he know about the planes that I don't?
Exactly. Is there a bolt loose that he knows about? Is there a software bug they haven't disclosed? It feels like the ultimate canary in the coal mine. But you always take a more measured view on insider selling.
You have to. You absolutely cannot view every single sale as a lack of faith in the company's future. You have to step back and look at the why.
Help us contextualize $3 million. Because for me, for most people listening, $3 million is I'm quitting my job and moving to an island money.
It sounds like a fortune to us, and it is. But for a C-suite executive at a company the size of Boeing, specifically someone who likely receives a huge chunk of their annual compensation in the form of stock-based comp or SBC, this is often just payday.
Right. They don't get a weekly paycheck deposited in their account like the rest of us. They get awarded shares.
Exactly. And when those shares vest, they are treated as income by the IRS, so they have to pay taxes on that income. Very often, they have to sell a portion of the stock they just received simply to get the cash to pay the tax bill. It's a mandatory process called sell to cover.
So the key metric to watch isn't the dollar amount of the sale. What should we be looking for in those filings?
You should be looking for 2 things. The percentage of their total holdings that they sold, and more importantly, the cluster.
The cluster.
The cluster of sellers. If Howard McKenzie, the chief engineer, sells 10,000 shares, that's probably fine. It's noise. But what if Howard McKenzie, the CEO, the CFO, and the general counsel all sell 80% of their holdings on the same Tuesday afternoon?
Then you run for the hills.
Then you panic. That is a coordinated exit. That signals they all see the same iceberg ahead. But this, 2 executives trimming relatively small positions. This looks like routine portfolio management. It's diversification. It's paying for a kid's college tuition. It's noise, not a signal.
So the takeaway is, don't let the scary headlines scare you out of a position unless the underlying data in the filing backs it up.
Exactly. Always look at the Form 4 filing. Did they sell everything they own? Or did they just sell 5% to rebalance their portfolio? It's a world of difference.
I want to zoom out a bit now. We've looked at these big individual stories, but I call this next section the market mosaic. It's all these little tiles of news coming out of tech, auto, and crypto that when you step back and look at them all together, they show you where the real stress points and opportunities in the market are.
I like that. Let's piece it together.
Let's start with Microsoft, ticker MSFT. The stock is up, and the rumor mill is churning about the next Xbox.
And specifically, the rumor is about a gaming handheld.
Right, the ticker feed cut off, but it said Gammon, so we're all assuming a handheld device. This is interesting to me because it shows where a giant like Microsoft thinks the future growth is.
It shows that they're chasing the phenomenal success of the Nintendo Switch and Steam Deck. They see that a huge segment of the gaming market is moving away from being tethered to the couch and the big screen TV.
But isn't Microsoft supposed to be the cloud and AI company now? That's the narrative that's driven the stock so high. Why would they bother with a little handheld gadget, it seems?
Yeah.
Small for them.
It's all about the ecosystem. They need to keep consumers engaged with their platform. I see it as a defensive move. If everyone starts gaming on portable Steam Decks, they might stop subscribing to Microsoft's Game Pass service. Microsoft is hedging its bets. They want to own the hardware you play on and the software subscription you pay for.
Okay, so Microsoft is chasing gamers. Meanwhile, over in the auto sector, General Motors is chasing tax breaks.
In Canada, yes. And this story is messy.
The headline we're seeing is Canadian politicians call for tax relief on General Motors severance.
Severance. That is the key word. You don't pay out severance if you're hiring people.
So GM is cutting jobs. Period.
It seems very likely they're closing a plant or significantly shifting production out of the country. And the politicians are caught in a classic bind. They want to look like they're supporting the laid-off workers, hence calling for tax relief on the severance checks. But they're essentially just subsidizing GM's corporate decision to fire their constituents.
It really highlights the tug-of-war these legacy auto giants are constantly in, doesn't it? Wall Street wants them to cut costs, be lean, and compete with Tesla on margins. But local and national governments want them to keep employing thousands of people in places like Ohio and Ontario.
It's the ultimate stakeholder versus shareholder conflict. And in an economy like 2026, where manufacturing might be tightening, that conflict is only going to get louder. GM stock might actually go up on the news of cost cuts, but the long-term reputational damage from these political battles could be very real.
One more chip in this mosaic. Let's talk AMD. The headline today is Strong Potential in 2026, despite an early setback.
I love the resilience narrative that's always built around AMD.
It really does feel like AMD is the little engine that could, doesn't it?
They are. They are the perpetual underdog to the behemoth that is NVIDIA, but the market needs them to win. The big hyperscalers, Google, Amazon, Microsoft, they do not want to be completely dependent on a single supplier, NVIDIA, for their AI chips. They want AMD to succeed to create competition and keep chip prices from going to the moon.
So you're saying investors are willing to forgive an early setback from AMD because the long-term thesis of a two-player market is just too important to abandon.
Correct. The AI supercycle is so massive that it's big enough for two winners. So AMD gets a pass on a bad quarter that other companies wouldn't. If Intel has a setback, the stock gets crushed. When AMD has a setback, investors say, that's okay, they'll catch up, it's a different standard.
You know who isn't getting a pass right now? Ethereum.
Ah, the crypto corner. And yes, it's looking pretty bleak over there.
It's just such a stark contrast. We were just talking about a $160 billion IPO party getting started in the stock market. But the headline for Ethereum is, can it survive the $2,000 death zone?
Talk about a divergence in sentiment. It's night and day.
What's driving the panic? The headline mentions ETF panic.
This is the hangover from the ETF approvals. Everyone in the crypto world thought the new Ethereum ETFs would be the golden ticket, that a flood of institutional money would come pouring in. But the actual flows haven't been what people hoped for, and now the regulatory environment is getting sticky and uncertain again.
So while the traditional stock market is clearly in risk-on mode, people are buying speculative IPOs, buying growth stories, the crypto market is in risk-off mode.
It really suggests that the decoupling is happening. For a long time, crypto and high-growth tech stocks moved in tandem. They were part of the same trade. Now it looks like they're breaking apart. It seems like investors are looking at Ethereum and saying, I don't need this regulatory headache when I can just go buy a hot new software IPO instead.
That brings us perfectly to the synthesis. We've covered Goldman's macro view, SpaceX's pivot, AppLovin's drama, Boeing's insiders, the tech mosaic, crypto's fear. What is the one through line here? What connects all these dots?
I think the through line is a single word: selectivity.
Go on.
Look at the incredible contrast in everything we've discussed. On one hand, we have this broad macro green light coming from a firm like Goldman Sachs. The economy is okay, money is flowing, confidence is returning. But then you have to look at the details.
The software route.
Right. You can't just blindly buy software anymore. You have to pick the actual winners. You can't just buy crypto. You have to avoid the asset that's in the so-called death zone. You can't just buy an industrial giant. You have to check if they're firing thousands of people in Canada or if the engineering team is selling off their stock in Seattle.
So the gold rush of 2026 isn't going to be a tide that lifts all boats.
No, not at all. It's a stock picker's market disguised as a broad bull market. The indexes might grind higher, but the variance between the winners, like the handful of IPOs that actually pop, and the losers, the older software companies that get re-rated lower, is going to be absolutely massive. In finance, we call that idiosyncratic risk taking center stage.
And that brings us right back to Ben Snyder.
The paradox.
I want to leave our listener with this final thought because it's what I'll be wrestling with all week. If Snyder is right, and this IPO boom is creating a sugar high for the S&P 500 that will be followed by a painful crash, how do you play this? What's the right move?
It's the classic game of musical chairs, isn't it? You know the music is going to stop eventually.
Exactly. If 2026 is the year of the big party, are you supposed to be the one on the dance floor, maybe even dancing on the tables? Or are you supposed to be the smart, sober one standing by the exit, quietly putting on your coat?
I think the smart money is dancing near the door.
Dancing near the door. I like that a lot.
You keep your exposure, you have to enjoy the ride, and try to capture some of the upside from this $160 billion injection of capital. But you have your stops in place, you have your exit plan. You don't fall in love with the hype.
Because when the music stops, and a guy like Ben Snyder, with all his data, says it eventually will, you don't want to be the one left holding the bag on a moonshot that didn't quite make it into orbit.
Precisely.
We will be watching that IPO calendar like hawks for you. It is shaping up to be a wild year. Thanks for listening to the Pro Ticker Deep Dive.
See you next time.
Goodbye.